Would you like to learn how to trade Google for a downside correction? Hi, I'm Larry Gaines, and in this video I'm going to show you two different swing trading strategies using options to short Google. So first off, here's the trade setup. You can see Google here on a weekly it's been trading off, but you can see here on a daily we had a trend line break here last week. We've got, this is an indicator I use, this is called a reversal cycle indicator. So we've had a cycle reversal here. This came in on the 14th, and then we had momentum signal trigger short on Friday. So we were looking for this downside kind of low area here. It's the key, support this 932 area. And you can see today, this is Friday's close. Google closed, in the lower part of its range, and today it opened right there. And so far, it's trading below. So two different short trade setups that you could look at for a swing trade move, and we're looking for a target down here to the 786, so about 927.5. So the first trade setup will be just a put debit spread, and the other trade setup is what we call a bear call credit spread. So let's take a look at these two option trades. So the first one, we're looking for this target, though. You need to always have a target in mind as to where you think it will go, and I like to use Fibonacci. So if we take the Fibonacci swing low to high here, you can see it's broken this 618, which is another key. So the next kind of level is right here to about 927. So the first trade setup was selling a bear call credit spread out of the money. So this was selling at about 1 standard deviation out of the money, which gives you theoretically about an 80% probability of a winning trade. So this was set up on Friday, and so it was selling the 952.5 call and then buying the 955 above it to protect and to hedge that case that broke through that short strike. So that'll be the first trade set. So the first one was selling a bear call credit spread, so selling a 952.5, buying the 955, credit of $45. Now you get it's a negative risk ratio, and the reason is because this was sold at about a 1 standard deviation out of the money on the setup, giving you about an 80% probability that it should close below 952.5. So you're going to get not as huge of a reward as you would if you were, buying options. So this would be about a, if it settles here and you keep the full credit, that'll be about a 22% return. And this was set up for this week's expiration. So currently at $15, so, about $30 profit. So if this gets down to about $5, we'll cover that back in. So that was the first trade setup. The other trade setup was done today, and that's looking for that target down here to about 927. So did a put debit spread. So in this trade setup, it was also buying the September 22 series, buying the 932.5 put, selling the $932.5 wide spread, 85-cent debit. So your max at risk is 85. Potential max reward is 165. So really nice positive risk ratio there. And currently trading about $1.05, $1.10. So it's got a little bit of money, but the thing is if it breaks lower, one last look here, if we get a better breakdown to the downside, this has very good profit potential. I hope that helps. Talk to you on my next video update.